Thank you very much, Tim. Yes, my name's Daniel Foggo. I'm the CEO and co-founder of Plenti. Plenti is a fintech lending business. We started lending in 2014 after observing that the bank model wasn't serving customers particularly well, wide spreads and relatively poor experiences. We also anticipated customers looking beyond their bank. We were seeing evidence of that starting to happen overseas. So we started Plenti confident that if we built a business with technology at its core that could therefore better serve its customers, then we could build a business of real scale in consumer finance in Australia. In terms of our progress to date, look, we launched as under the name RateSetter. We rebranded just before our IPO last year, where we raised $55 million. We are now the largest fintech consumer lender in Australia. We've funded over $1 billion in loans. Our loan book is over $500 million. It's worth mentioning, I think, as a business, when we started, we've always thought of it in 5-year increments. And the first 5 years was really about building foundations, which I will talk us through, and the next 5 years really about building scale. And on the scale piece, the IPO was obviously an important milestone in that regard, gave us some capital to really scale up and leverage our foundations. We beat our prospectus forecasts. We subsequently released a quarterly update in December and showed that we've continued to grow very strongly. I'm just moving to the next slide to talk to our strengths as a business. There are a number of things that set us apart from others as a business, and particularly apart from incumbents. The first point is our technology platform. We own our own technology platform, which is, serves our customers from end to end. That's actually relatively unique in the lending space, and we see it as a key advantage. It allows us to provide superior experiences to our customers. It allows us to achieve better economics as a business, and in particular have real operational leverage. And it allows us to continually innovate. And I'll explain to you how we have innovated as a business, which is helping us to underwrite our future growth. The second is our diversified lending products. We started off in personal lending. We diversified into renewable energy, so loans for household solar panels and batteries, and also into automotive finance. That diversity brings real resilience and also real growth. To talk to that, automotive lending is now half of our originations or thereabouts, so that diversity has very much been key. The third point is our funding. We have particularly diverse funding, which we think makes us a very resilient business. We started off with a peer-to-peer lending model. We introduced a number of institutional investors, and we've now got our own warehouse facilities. The final point is our credit capabilities. We've invested heavily in credit people and technology, and that is evident in our credit track record. There's some statistics there on the right, some key points there. We've funded over 60,000 borrowers. We've attracted over 20,000 investors, and our run rate revenue is over $50 million. Moving to the next slide, which talks a bit to growth. So we're very excited in November last year to have been the first fintech consumer lender to hit $1 billion in originations. And then you'll see the last bar there on the right on that chart on the left. That is our origination growth in the final quarter of last year. And you'll see that's really showing an acceleration in origination growth. The chart on the right really reflects that. You'll see our CAGR of our loan book growth over the last 3 years of 60%. And again, you'll see in the last quarter, particularly strong growth in our loan book. You'll also note that we've been very deliberate in our growth, very consistent growth in our loan book, and that is about doing things like proving up one's credit track record and capabilities and making sure you've made the right investments in your technology. Moving on to the next slide. This really talks to the verticals in which we do operate. Each of the verticals is very large. Each is undergoing a significant change, be that structural change, regulatory change, or really technology disruption. And across all three verticals, we're seeing that mean that incumbents are losing market share and businesses like Plenti are picking up that market share. I might just focus on the automotive market. The automotive market is vast. It's over $30 billion of originations every year, but actually often hidden from investors, and that it's historically been hidden within some of the car manufacturing companies, or within the big four banks and Macquarie in Australia. To give some perspective on that scale, it's larger than the credit card market, and also in terms of buy now, pay later, substantially larger than that market as well. It's also very attractive from a credit performance perspective in that you've obviously got security over the assets. What's really exciting for us about the automotive market is you are seeing a lot of the large incumbents exit. So we saw ANZ sell its over $10 billion loan book to Macquarie. You've subsequently seen Macquarie narrow its focus in the automotive market. And as most of you will be aware, Westpac has now announced that it's looking to sell its automotive book. What that's really leaving is a vacuum for other lenders to build scale. And when you align that with a need to better serve customers, to deliver faster turnaround times for brokers, for dealers, for the end customer, that the vacuum there is really being filled by those that are most nimble, those that have the best technology, those that are able to serve their customers the best. And again, we see that really playing into our hands as a business. And to put some perspective on our performance in that market, in our December quarterly update, we showed our originations during the quarter were 270% up on the year prior. Still very small though, relative to the size of that market. So we see a long runway in terms of the growth opportunity there. But across all three of those verticals, we're very excited about how they can each contribute to our expansion as a business over time. Moving to the next slide. Look, our ambition as a business is to be the best lender in Australia. Core to doing that or achieving that is our technology platform. It is allowing us to rethink lending from the bottom up. And as I mentioned, it's a key point of difference in a number of ways. It allows us to deliver those superior experiences to customers. That is easier applications, faster loan approval, much simpler settlements. We're just about to launch a commercial automotive loan offering, and we are expecting to be the first in the broker channel to have a fully digital settlement process, which sounds quite strange in the modern era for people to be still signing documents with a pen, but that's the case at the moment. So you can see how technology can be really a point of difference. The other thing is that our technology platform allows us to improve the economies of our business as we scale. We really are a platform business. So as we scale, if we double our loan originations, we'd expect our headcount to grow more like 20 to 30%, which is along the lines with what we've achieved in the last year, as opposed to it being consistent to your actual origination growth. And then finally, it allows you to do things like improve customer conversion rates. That means when you spend money on marketing, then you can extract more value from that marketing spend than what other businesses might be able to. Moving on to the next slide. We are a credit business, so it's very important, particularly around profitability, to make sure that your losses are sensible. I think that's a key point of difference for Plenti. You'll see on the left there, it's the average credit score, which is a guide as to what losses might be over time for different asset classes. The point there is that our average customer is actually a better credit than what the average bank loan customers will be, or personal loan customers will be. I think that's a really important point about our business. I think historically listed companies in financial services, which are not the big banks, have often looked for niches or areas where the big banks are not participating. That's not what we're doing. We're going after the very large markets that the banks are already operating in. In terms of the charge-off rate on the right, on the left side of that chart, or the early period, is really reflective of our personal loan volumes, those loss rates being around half what a big bank might have as new to institution customer loss rates. Well, you see on the right there, that's declining quite substantially. That's on the back of our move to lower risk renewable energy loans and secured automotive finance. Also helped a little bit by a lot of government stimulus more recently. Moving to the next slide. To talk about funding, we'd emphasize a few things here. Obviously, very diverse funding, as I mentioned. We started off with a retail platform, attracted over 20,000 investors. We've now got 8 different banks. We've got the government's Clean Energy Finance Corporation funding loans. And then in the last 18 months, we've set up 2 warehouse facilities, which have total headroom of $375 million, which has helped support the growth of our loan book. All of these funding sources are scalable, so it gives us great confidence around being able to support the growth of our loan book over time in any economic environment. And also importantly, what we have done as we've leaned more on warehouse funding is we've reduced our cost of funding quite materially. On our new originations, the cost of funding is down over 300 basis points over the last 18 months. So really reflective of that cheaper wholesale funding. We'll also look to do our first term deal during the course of this year, which should reduce our funding costs further still. Moving to the next slide. Our medium-term priorities. Really, this is about building scale for our business. We want to be the leader or establish a leadership position in each of the lending verticals we're in. Part of that is about introducing new product features and a new product suite. We've successfully diversified our lending to date, not just across the 3 verticals that I've already mentioned, but also how we distribute those loans through digital channels and through referral partners, B2B type relationships, which actually represent most of our originations. In this regard, we launched a buy now, pay later offering specifically for the renewable energy channel earlier this year. The beta performing very well with over 80% uplift in demand. We're also launching a commercial automotive loan offering over coming months. We're looking to extend our technology advantage around the points earlier, bringing efficiency to our business, being smart around credit decisioning, and then finally optimizing our credit costs even further. On the final page there, I've mentioned we believe we've got exceptionally strong foundations. We're in large markets. We see plenty of runway for strong growth to be continued. And then the final point I'd make there is we've got a very capable team that's very committed to taking Plenti the distance. If you'd like to learn more about our business, please do visit our website, plenti.com.au, and I'd love to take any questions that you have.
Thanks, Daniel. I was actually on your website. For the direct investor who wants to loan money, how does that work for them?
It's quite simple. We have 6 different lending markets or investment markets, so they can choose a term of their investment, and they can also choose to invest in 2 renewable energy markets. So, ESG is a real focus for our business, and giving investors access to investing in household and commercial renewable energy is important to us.
And why is that renewable energy vertical such a focus?
Look, it's an attractive market in terms of the size. There's well over 200,000 installations of solar panels in Australia every year. They're increasingly being coupled with batteries, which increases the size of investment and also increases the need for finance. Tends to be very good from a credit perspective. So we really like it in terms of size and credit. There's also a smaller number of competitors. And finally, state programs are important in that regard. We run one for the South Australian government. We're running a pilot for the New South Wales government. So it gives us a good way to establish a real scale.
And the car loan books that the banks are kind of walking away from, they don't generally walk away from profitable parts of the market. Where's the opportunity for Plenti in that space?
Look, I think they've had changes around regulatory capital for those loans. And I think what we've seen is they have been struggling to keep up with the technology investment requirements to serve their partners sufficiently and also the end customers sufficiently. So I don't think that's they're walking away because it's not attractive. I think the way they look at this going forward is actually they're probably better off funding businesses like Plenti rather than having the direct engagement with the customers.
And any other verticals that Plenti would look towards in the future?
Look, great question. We ask ourselves this regularly. I think for us at the moment, it's really about scaling up in the verticals we're in currently. They're each really large opportunities. But look, we have built our business so that we have the ability to move into new opportunities over time where we see them being attractive. So, I think we'd roll the clock forward a couple of years before we're looking to add to our current 3 verticals.
And just a question here on, the capital requirements for Plenti to grow further.
We've got a good, I think in the December release, we showed our corporate cash, which was around $50 million. As we grow our loan book, yes, there's equity funding requirements where we're using warehouse or term deals. There are different funding options available for funding those sorts of commitments. So it doesn't necessarily need to be with equity. But look, as we build a multi-billion-dollar loan book, then there may be times in the future where equity markets are relevant, but there are other ways for us to think about funding that for the near and medium term.
And as you build that kind of loan book, is the focus on kind of institutional lenders, the super funds and the like, who are obviously looking for a better return on the cash?
I think it's often easiest to go through the sort of banking system and mezzanine finance through warehouse facilities initially, and then you term out to other investors, including the superannuation funds. So we do expect to do our first term deal this year. It's important we build a real brand and presence in that market, and that should give us continued access to capital over time.